Good morning, ladies and gentlemen. Well, minus 22, and we basically finished the week at worse levels. We are in risk off in the monthlies, and we will be in risk off in the next couple of days. It's quite obvious in the dailies, and by the end of the week, most probably in the weeklies as well. You have some very bad scores coming in and continuing. So the moving averages are nearly bound to cross over in the next 2 or 3 days, and also in the weeklies. I really have very little hope that it'll be in risk on by the end of Friday. Basically, as simple as this is lasting and people are liquidating their positions into it. All that can be said is this is not going to be a flash in the pan. It's going to continue, and that's why you need to have some levels, and you need to look at deviations, and you need to look especially at the counter trend to see when a bounce would happen. In times when volatility is as high as it is, you really want to start catching it at the third standard deviation and lower, i.e. below it, simply because volatility is this high. We provide these for you every day to look at, and you can see that every time it goes into these white ones, eventually it gives you a rally. This is a very nice ABC. So the fear now is that we continue lower, but I'll examine that in more detail in the equities section. But have a look at how far certain sectors are. It really is incredible that that has happened, and it shows you the extent of the panic, and we will have a look at that in the volatility section as well. There are some incredible opportunities to be had in these markets, which I will tweet to you as I see them over the course of the week. To me, the best results come when technicals and fundamentals realign. You can see here the times 15. To me, the times 15 Blue Angel is where the market goes to at the worst of times, and you can see where it is. It's just below 2700. Let's call it 2650. If we had an ABC, and we will have a look at that there, to me that is probably one of the finest opportunities you will have to get long of US equities for the next decade plus. So keep on looking at this. I know that we don't know where the E in PE is, but I feel that the market is definitely discounting some very bad outcomes, and we will have a very good opportunity around these levels. If you remember, this 26.25 level was fantastic, and look by coincidence where the times 15 line is at the moment. Well, what an absolutely incredible week in fixed income last week. Every single level that I mentioned just got hit and went through it like a knife through butter, even the 68 basis points in the 2 years. It closed basically on top of the all-time low at 51 basis points. Now, there is no point in going through the 5s, the 10s, the 30s, because the picture is the same in everything. But what I would say to you is this. There is no way that rates in the US go negative. Why? Because that would mean that every money market fund, and they hold trillions of dollars, would break the buck. Now, the Fed tried its utmost not to allow it to happen during 2008, when there was real destruction of wealth, as opposed to this, which is just a panic. They're not going to allow it to happen. They just will not allow it to happen. They will do every other measure they can think of before they allow negative rates in the US. And therefore, that is why I think that 2s, 10s at these levels of rates are the only thing that makes sense. I told you that last week when it was down here It rallied 20 basis points and gave back some, but I don't think this is enough. I think we will probably see the two stands over 50 basis points at some stage. To me, this is a trade which makes fundamental and technical sense. I could go through the bunds and the bobbles, but there is no point. There is no point because this is the story. It's the differential in yields between Germany and the States. Budumph, straight down to the levels that I mentioned and straight through the lowest levels that we have seen since 2016. Now, can you keep on going? Of course you can keep on going, but the likelihood isn't, will he go through 150, 148? Yes, possibly, but we are approaching the end of the road. The yields in Germany can remain at -70, and I doubt very much that we get much lower than 50-60 basis points in the US. To me, that is almost impossible. And 70 plus 50 is 120. 70 plus 60 is 130. So I would argue that we are within 10-20 basis points of a very good bottom in that differential, which would also support the dollar for a bit before the dollar, before everybody starts getting out of the dollar again. So let's look at the dollar and see what is likely to happen there. To me, from these levels around the 125, these spikes, the path of least resistance is up towards a correction towards this kind of level, 170, 175. And that really gives you my views for what is going to happen to fixed income and by extension to equities at some stage. Last week I said that the dollar was going to act as a shock absorber for the US and would head towards this very important level at 96.47, 96.50. We broke it on Friday. Now, do I think it just keeps on going to the next levels, 95, followed by 93.63, followed ultimately by 92.50? Yes, I do, but I don't think it's going to be quick. A, because it's very oversold, but B, because the differentials are now going to settle, as I just showed you in the previous chart. So I think we do have a chance to rally towards the 97 area, 96.50, 97, and that will definitely be the opportunity to put on some spreads, looking ultimately for lower levels. Why do I think lower levels? Because I could think the US administration is going to be keen to continue using the dollar as a shock absorber, and this is basically the big picture I'm looking at. Every time we cross below this moving average, and when the really bad things happen, we go down towards the 93 level. That is on the weeklies. If we have a look on the dailies, that is actually down here, the 93.60 level. I would have thought we have an A, B, C down towards the 93.60 level, and that would actually probably tie in with an ABC in equities. Who knows? But that is more likely than not. I certainly think there is very, very little likelihood of the dollar exceeding this 97.50 to 97.87 area for the foreseeable future. The path of least resistance after a bit of waffling around the 96.50, 97 area would be down towards the 93 and 92.50, which in weekly terms makes a lot of sense. We are still in a range, but we test the bottom of the range. That helps the US economy recover, and then we probably go up again. For the past couple of weeks I've been saying that really I see much better things to hedge with than gold, And that has really been proven more or less correct, because gold is just staying at the top of the weekly Bollinger Band. It's not exceeding it by much. I do expect this kind of level 1763 to be touched through the course of the next several weeks, simply because of the weakness in bonds and the projected weakness in the dollar. That should make sense for that kind of level to be reached. But the real story isn't in gold, the real story is in oil. And really, now that we have seen the how much the Saudis are keen on getting the price down, we can and causing a complete trade war, we can easily say that we will see lower prices over the course of the coming days. I think this 37.75 level, which is very important, is going to be seen almost immediately, and quite possibly we will test the all-time the lows of the past few years here below 30, around the 25 area. Would not be surprised at all, and I think that is very, very bad for the US shale industry. I think the move by the Russians here is to take out the US shale industry for as long as possible. That is not good for corporate spreads. That is not good for anything. So I do expect a marked re-evaluation of bad corporate spreads in the US over the course of the next few days, and a market differential between Russells and NQ and things like that. I think the Russell to NQ spread could go a long, long way. Before we get into equities, I wanted to show you the volatility chart, because that really will tell the story for equities. Now, I've marked down all the levels that I think are important. Here we have the 43% level that we managed to close just below last Friday. I'm not saying that is very significant or anything like that, but what I'm trying to show you is the periods of volatility. When we have managed to hold the 43 level on a closing basis, we got a couple of months of high volatility averaging between, here we have it, 30 and 40. Could that be what we see? Yes, it very well could be. So you really do not want to be short of volatility. There is no point, because you will have several weeks and months of opportunity to short volatility back up in the 40s and 50s. This is not going to be a one and done kind of deal, simply because the uncertainties are too great. But is this a period of destruction of value, like the great financial crisis here in 08, where we got volatility up to 80? I don't think so. I really don't think so. This is going to be a period when the banks are when the governments are going to be bending over backwards to help. And I'm not talking about bailouts, because nobody needs a bailout. If you are having a tough time with 2-3 quarters of low revenues because of the virus and everything else that entails, you only need deferment. You don't need a bailout. So a deferment of taxes, new initiatives, fiscal expansion, all these things are going to be bridges towards the end of the viral contagion. So my argument is that it looks much more like this and this here than it does here. So to me, volatility is going to be in the 30 to 50% range for the next several weeks. When things are particularly bad, we get up to 50. When things are particularly good, we get back into the 30s. And that colors my view of what is likely to happen to equities. Now, bearing in mind what I've just said about volatility, I want to look at the indices from the least bearish to the most bearish. The least bearish, funnily enough, is NQ. That's just a fact. Now, I will allow for the possibility that this is an ABC down and that we see much worse levels, but we are not even at the lowest level of the Bollinger Weekly Band. I'm not even going to look at the dailies and shorter time frames. It just doesn't pay. To me, this 7,788 level is as important as 2864 in the S&Ps, and that comes at the lower Bollinger Band. And then finally we have this level down here, which is at the moment completely out of range, I think, 6,586. Those are the levels that I'm looking for on the weeklies, and if we look at the monthlies, those actually tie in very well with the levels on the monthly Bollingers, which are down here, and we never approached this moving average, even the worst of last year in December 2018, and this is the 6,700, 6,800 is the 0.786 retracement. To me, these are very sensible levels to buy. First of all, 7,800, followed by 7,300 here, and finally 6,740. That is assuming that we get that kind of a move. Those are very sensible levels. On the upside, I really feel that last week this was a gift up here with the monthly Bollingers. It was just a fantastic level to get out, and it coincided with 3,125, 3,135 in the S&Ps. In ES, the picture is different. You will see how this 3,130 odd level was a fantastic level to get out. As I tweeted, above 3,125 I revert to tactical. We held, basically this is a weekly doji, we held the lower Bollinger Band, and I would presume that we will hold the 2864 level. But with the level of volatility we're seeing, and it is not at all unlikely that we go to the next level in the S&Ps, which is 2,740-ish. Okay, that's 0.618 retracement of the whole move. And finally, we have these levels here around the 2625 level. To me, 2625 is as bad as we can see it over the course of the next couple of weeks. But we have overwhelming risk-reward levels for big bounces. And this was a huge bounce from 2864, and I would expect from 2740 or 2625, which I showed you again how it coincides with the Blue Angels. To me, this is the level that you throw the kitchen sink at this. If we have a look at the monthlies, we can see again that this coincides very well. What a beautiful level here at 2745, and what a fantastic level here at the lower Bollinger Bands and the moving average around the just below the 2600 level. 2630 to me is very, very unlikely to be broken, exceedingly unlikely. But the worst of the worst to me is Russell. And here is a monthly chart of the Russell. Why should the Russell be worse? Well, because it's overweight in energy and it's overweight in financials, which are getting killed. So really, the level that I'm looking for in Russell is 1287. That will be my line in the sand. And I would guess that that would coincide with one of the other two levels apart from 2864 in the S&Ps, and that is what I would not rule out. you can see how the Russell is now at the same level as the S&P was when it was trading 2864. So the Russell should break and lead. If the S&Ps have any chance of breaking 2864, the Russell has to be significantly lower than the close of last week. Watch Russell, followed by S&Ps, followed by NQ. It is quite possible that if the market gets really panicky and volatility goes back towards that 50 level, that you see the Russell down here and the S&Ps no worse than say 2740 and the NQ at the target that I mentioned. The other market which I consider to be the least favored at the moment, and you can see that it's through the weekly Bollinger Bands, is the stocks and or DAX, same thing. These are the levels that I'm looking for to coincide with some level in the States where the bounce is most likely. Here we have 3060 and finally 2747. You can see how those levels were exceedingly important back in the past and why I choose them. I would not be surprised to see those levels in this market simply because it is the one with the least support. It is the one where the bond market is providing least support for, and the ones that have the least natural bias. So those are my bias levels for bounces, even in the shittiest of the shit. These markets are the ones that are giving up and the ones that which are making constantly lower lows, even when the S&Ps are 100 points above their worst levels from last week or the week before. 2864 is nowhere near to be broken in the S&Ps, while the stocks are breaking and the DAX are breaking those levels. So look for those to lead and look for the S&Ps to stabilize at the levels that I have indicated. Well, what are our biases? It's incredible to think how far we have come in the bond market. To me, the only thing to look at is for the 2s, 10s to hold support at 14.15 and start moving out above that 30 level and start going towards 50. If that happens, I think we are stabilizing and the market is looking to bounce significantly. Now, I have told you that the VIX, we need a close above 43 to take us towards 80. I don't expect that to happen simply because it would be too easy. It would be too much of a sell up there. I expect a week between 30 and 40, which in the end gives us possibilities for breaks below 2864, but I still believe that 2864 is going to be a very tough area to break. I've indicated here 2864, 2740, 2630. 2630, 2625, whatever it is, you throw the kitchen sink at it via calls. We need to clear the 3140 to 3160, 70 area to say we are in the clear. This is for later. This is not for now, but for later when we do get the bounce, and we will get the bounce. Those levels to me are all important. NQ, I've put the levels that I think are realistic for next week, from where we should get a 200-300 point bounce without any doubt. And the DAX and the stocks, which are the worst, 3060 and then 2750 if everything falls apart. But we need a close above 3530 for an all clear. And to me, this is the least favored market together with the Russell. In the dollar, I said what I think. This is what I wrote last week. My first target is 95.07, but only after we have bounced up towards 96.50, and that is the level that I would have thought we'd do some some bearish plays on the dollar. The ultimate target, and I think I do think that we'll achieve it, is 93.13 to 92.50 area, but I don't think it's going to be a very quick process. I think that's going to take several weeks, if not months. Thank you very much indeed. May God help us, and I'll tweet you on Monday.